And welcome to the Prescribing Prosperity Podcast with your hosts, John and Alex Soutsos. Gentlemen, good to be with you again. Lots of things to talk about as we record this at the beginning of 2025. How are you?
Great, Bill. Thank you very much. It's always great to be with you.
No, I really enjoy it. It's a pleasure being with y'all. I really do. So on the agenda today is the market overview, look at what's ahead for this year of the snake, which as we record this is underway. And I might add that the year of the snake, traditionally in the Chinese calendar anyway, is deemed to be a pretty good year in terms of fortune and wealth. So hopefully that all plays out well.
That's that animal can create all sorts of interpretations when it comes to politicians. So we don't want to offend anyone, so we're not going to go down that path.
No, that's fine. So where do we start, John? Where do you want to start this conversation?
Alexander, do we want to start in a particular spot?
I think we should start with Trump. I think that's the
I don't think
overarching topic.
That is the big gorilla in the room. Okay.
Yeah. We went to a due diligence conference last week, and Trump derangement syndrome was at full capacity on full display there, and so it seems as though there's this big cloud that's hanging over everybody. And it is whether or not, the 47th president of the United States is going to, I don't even know what they expect he's going to do. But anyway, it is the big cloud hanging over everyone. And so we should probably address the elephant in the room and see if we can dive into the topic and provide some perspective.
Well, and if we're going to do that, then we have to start with tariffs, gentlemen.
So obviously, this President Donald Trump is a type of character that really splits the crowd down the middle in any room. Although these days, I think the crowd is leaning in his favor for a variety of reasons. But being here in Canada and the discussion of tariffs is obviously a huge topic. The media here in Canada is in a tizzy over the tariff situation. The government's at a very high level of fear with respect to the tariffs. And our viewpoint is really to go back to the first Trump presidency and see what he did in his first go around with tariffs. And so with respect to both Canada and China, tariffs were applied in a strategic fashion for a limited amount of time to achieve the political ends that President Trump wanted. So at the end of the day, they did not have any impact on inflation. I know that everyone who's criticizing the utilization of tariffs say tariffs on their own are inflationary in nature. Well, if you open up a tariff and you leave it indefinitely, yes, potentially they can be inflationary, but that's not how Trump uses tariffs. He uses them as a stick to provide incentive to the person he's negotiating with to go his way. And so when we look at personal consumption expenditure and CPI, both inflation statistics from 2016 to 2020, we see that inflation began. The presidency began with an inflation rate above 2%. And in the case of the CPI, it was above 2.4%. And then by the time the presidency ended, both inflation rates, the PCE and the CPI, were below 2, and in fact, near 1.5 in the case of personal consumption expenditure index. So I don't think the tariffs are going to be applied. If they are applied to Canada, I think it's going to be temporary in nature. And even if they are, so once the tariff is lifted, then we'll go back to playing nice and meeting the objectives of both sides. And frankly speaking, as a Canadian, the question I ask is, why does it take the leader of a foreign country to tell us that we should secure our border and stop fentanyl from crossing it? So if anything, I think this is doing all Canadians a great favor in focusing on the fact that our border is porous, or has been porous over the last decade. We do have a problem with drugs crossing the border, and we should be addressing it. And it shouldn't take a foreign leader to tell us that. So
not just drugs, illegal migrants as well.
illegal migrants, and you have child trafficking. There's a lot of bad things associated with people crossing the border without permission. And we should have addressed it on our own. And the fact that now President Trump has focused a spotlight on it, I think, is doing us a favor. And I think once we address that ask, which is not a big ask, really, once we address that ask, then the tariffs, if they are applied at all, will go away rather quickly. So I'm not concerned about them in any way as far as Canada is concerned. And historically, we haven't seen their utilization by Donald Trump as them causing any type of inflation. So I'm satisfied.
It will be interesting. And by the time this episode is released, we'll have a much clearer picture of what exactly is happening.
Right.
Because as we record this, Trump has made it clear he intends to impose the tariffs. But as you point out, John, quite correctly, I think he has a book about the art of negotiation, if I remember correctly.
I read it when I was a very young man. And, in the conversation we had before we went live on the air today, I mentioned that having the tariff threat is like a teacher or a professor saying, look, you have an essay to submit. It's due by this date. And if you don't get it in by this date, there's a 5% penalty or a 10% penalty. And so it's an incentive to get the job done. It's not that the teacher or the professor gets some great satisfaction out of punishing you. It's they just want you to do the work. And really, that's all that's being asked of Canada is get the job done, secure your border. It's good for us. It's good for you. It's good for everyone.
Well, there's a saying, there's nothing focuses the mind like a deadline.
Exactly.
That is true.
Yeah, we all have deadlines, right?
Yeah, no, I worked for years on daily deadlines, and it was like, and believe me, nothing will focus your mind and your attention like that looming deadline when you look up and you're going, I got 2.5 hours. I need to get this done.
Yeah.
So what are your overriding themes? What are you looking at in terms? Let's start with the U.S. market, since we're talking about U.S. and Canada. What are your overriding themes, and what are the things you're paying attention to, guys, for the U.S. market?
I think the overriding theme is the shift by the new president back to a free enterprise economic system, and that is a very good thing because his emphasis is on deregulation, tax cuts, and giving people the freedom to make their own choices. And these are disinflationary strategies, reducing the size of government. In the short term, that could be a bit of a fiscal drag, obviously. But once that is done, then you actually get a tailwind, and that will boost the economy. So I'm looking at the U.S. The economy to be very prosperous and to expand at a good pace in the future in the next few years, and that's going to be good for the U.S. Capital markets. That being said, the stock market can't outgrow the rate of corporate earnings growth for an extended period. That is the gravity that keeps pulling it back. Is the valuations have to adhere to that trend line. Right now, we're a bit above that trend line, so because we're above that trend line and any type of unusual externality, like
easy
DeepSeek,
for you to say, John,
like we had this week with the Chinese AI offering DeepSeek.
Yes,
anything like that can derail the market very quickly. But right now, the market is resting on strong fundamentals. We've had 4 years or actually, I shouldn't say 4 years. No, I can probably say 4 years. We've had 4 years of excessive government spending, which has caused the economy in the U.S. to improve and grow, but it brought along with it inflation. And now that money that boosted the U.S. economy, the borrowed money, is petering out. And so you need the private sector to take over. And I think the new leadership is doing exactly that. They're going to allow the private sector to take over the function of economic stimulus. And that is a better way to do it because obviously the fiscal house in the U.S. and many other Western countries has to get under control because it's been running rampant with significant borrowing by everyone in the Western hemisphere for far too long. And so I think there's an attempt by the new administration in the U.S., especially with the Department of Government Efficiency, to get that under control. And if the U.S. leads in that area, chances are other countries are going to have to adapt and follow the lead. And you'll see it with corporate tax rates. So corporate tax rates over the last 4 years in the U.S. especially, but in Western Europe and even in Canada, corporate tax rates have been migrating upward for a long time. And once you get the U.S. adopting lower corporate tax rates, competitive forces will cause Western Europe, Canada to perhaps follow that lead, bring corporate tax rates down, and that's going to be very net stimulative for their respective economies. So I see all of this stuff, Bill, as very positive. It's just with respect to the market, it has to stay close to the trend line of corporate earnings growth, which this year is expected to be quite strong. And Mag 7, the Magnificent Seven big tech giants, are expected to grow by 21%. The rest of the market, 493, are expected to grow by 13%. Those are very, first of all, above historical trend line for corporate earnings. And so that means we should have a good year in the U.S. market. Now, what's the number going to be? I don't know. No one can answer that question, but we should have a positive year.
Interesting. I want to know what industries you're looking at, but before I do that, I want to go back to the corporate tax issue because, as you know, under the Biden administration in the United States, we were partnering in this effort to create a global minimum corporate tax. Do you think that initiative is going to be abandoned under the Trump administration?
Absolutely. I think Trump has made that very clear. He's abandoning that. He has already said, well, here's our new corporate tax rate, especially if you manufacture here. And that's going to force their hand. And you have other countries, it's not just Trump. You look at what's going on in Argentina. They have a libertarian-minded leader, Javier Milei, there that has completely taken the chainsaw to the bureaucracy of Argentina, has rationalized that government over the course of a year, and has gotten their economy under control. Then you have Giorgia Meloni in Italy. In France, as you know, there's a potential transition happening to Le Pen, which is the right-wing political leader.
Ireland is the poster child for low corporate tax
Yes.
rates. When we were at our
right.
presentation last week, they were listing the healthiest economies. They did an objective metric on who are the healthiest economies in the world. The second healthiest economy in the world is Ireland. Who the hell would have ever thought Ireland was?
Wow. No, that's a revelation. No, I did not know that.
Well, just to piggyback on Alexander's point, Ireland originally went to a 0% corporate tax rate. I don't recall how long ago it was, maybe 20 years ago. Today, Ireland has the highest per capita income of any other country in the world. Think about that for a second. The people who left because of a potato famine 200 years ago, today are leading the world in per capita income, higher than the United States. And so you got to start asking some tough questions if you're an American. Why are we the largest, most diverse, most dynamic, most innovative economy in the world with the most money and the biggest military? Why are we lagging Ireland in per capita income? And so that tells you there's been a problem in terms of taxation in the U.S., and hopefully it's going to be remedied in the near future.
Wow, that is amazing. So, okay, let's get practical here. Where are you looking? Are there sectors that you're looking at, or give us an idea of what you were looking at?
So we believe that there are winners and losers in the new presidency in terms of economic sectors. Among these winners, we believe the energy sector, the traditional energy sector, that is not afraid to use fossil fuels of any kind. I think the renewable sector will be hurt because they're no longer going to have tax incentives attached to them. But by the same token, in a free market system, and the new administration has said explicitly, look, if you want to buy an electric car, go and buy it. If you want to buy a gas car, go and buy it. It's your choice. So the private sector is going to decide how to allocate limited resources. And we think when the private sector does that, that the cheaper vehicles and the other areas of the economy that benefit from lower energy prices are really going to benefit. So we think energy is going to be strong. We believe autos are going to be strong. Autos may also be strong for another reason, because there's an incentive now for reshoring of automobile manufacturing in the U.S. But the big thing, as far as I'm concerned, is our small and mid-cap stocks. So as some people may be aware, the S&P 500 index derives approximately 40% of its revenues from international sources. So if you have a president who's saying, I want to focus on the domestic economy, small and mid-cap companies derive almost 100% of their revenues from the U.S., in which case those companies, after being left behind the last 5 to 8 years, they're really should experience a resurgence. Plus, you also have interest rates starting to come down, and obviously, Apple doesn't need to borrow money. You know, they're cash cows, but small and medium-sized companies require debt in order to finance their growth. And so the fact that inflation's coming down and interest rates in the banking system are coming down is going to allow the small and medium-sized companies to get the debt they require to expand. So I'm looking at small and mid-cap stocks. Also, financial service companies, obviously, they're going to benefit with a falling interest rate as well. So there's opportunities, I think, in the major banks. There's also opportunities in regional banks, but also in perhaps some asset managers.
Interesting. What I like here, looking at your list of things, is that technology is on this list, and I look at it with kind of amusement, because I obviously been covering business and financial markets for a long time, and technology with a lot of money managers for a long time was a dirty word, which I never quite understood, because I thought what was happening in the economy is where once upon a time, you would go to a financial advisor and they would say, well, you need to buy the names. You need to buy the names. You need a General Mills. You need a Procter and Gamble. You need a Johnson and Johnson. And I kept thinking, at some point, aren't they going to say, and then we can't ignore the fact that we have an economy that runs on technology and technology stocks?
You know, it's interesting you phrased it in that fashion, because I'm a believer in having a portfolio that has a balance of both growth-oriented companies and companies that are more defensively oriented. And you mentioned some defensively oriented companies,
right?
And I'm all about defensively oriented companies as long as they also have some growth. So it's wonderful to buy Procter and Gamble, but I'm not going to buy it just because it pays a dividend. It has to demonstrate that it's still growing its earnings, and we're still going to get a rate of return that's going to exceed bonds over a 10-year period. So yes, you can include those companies, but I think it's critical, more important, and Alexander can attest to this, is it's more critical to be agile. And that's where a lot of money managers, I think, fail, because a lot of money managers are institutional in their targeting. And so institutions have time horizons that are forever. They don't care about volatility to the same extent. They feel as though the individual investor has a better understanding of their own tolerance for volatility, and that they're going to have a portfolio that is suitably allocated between stocks and bonds to meet their volatility objectives. And so they don't really, they'll buy the names you mentioned and perhaps some other names even on the tech side, and say, we're buying and we're holding for 3 to 5 years. I think that's a wrong approach. And and not only do I think it's a wrong approach, the evidence demonstrates that it's a wrong approach, because in our work, we are constantly competing with institutional investors. We see it in the all-in-one package solutions offered here in Canada by the big banks, but they're also offered down in the States. And what you find is mediocrity. They're not designed to outperform. They're designed to get in the middle lane of the highway, stay in the middle lane, periodically go in the right lane, and let everyone pass them, because their viewpoint is, we just want to keep the asset. We just want to keep making our recurring revenue from the management fee. We don't really care what rate of return we provide, as long as it's within the range of acceptability for the investor. Whereas someone who is running an independent a portfolio service like us is more interested in competing and being aspirational in our strategy. We want to provide the returns required by people to get to their objectives, not to come close to their objectives. What's the point of getting on a boat and they drop you off 100 feet from the shore and now you got to swim the rest of the way? That's not a solution. We want to get people to the shore and disembarked in a dry fashion so they can enjoy themselves. And unfortunately, the majority of people, both in US and Canada, have not been able to save sufficiently for a variety of reasons. And they have not been investing in as productive a fashion as they could, perhaps out of fear, or perhaps, or more likely out of poor guidance from who they're dealing with. And so they need a higher rate of return. And you can buy all those names you mentioned, P&G and J&J and all those other good companies, and they're good companies,
Right.
but they're not going to get them to their destination. You need to imbue them with some growth-oriented firms, and that obviously brings in technology. And everyone knows the big 7 tech names, and they're still going to provide probably a very good rate of return in the future. But there's a lot of companies beneath them in the mid-cap space that have even greater potential. And you need to be able to identify them, target them, and bring them into the portfolio in a fashion that is suitable and appropriate and not excessive. And I've been doing that, in fact, since the middle of last year. I think the market, as you know, Bill, is a discounting mechanism. It looks ahead. And in a presidential election year, if the Republicans win, historically, the return tends to be 15.3%. And if a Democrat wins, it's about 8.3%. And so the fact that the market was up over 15% by the end of the first quarter last year, to me, the market was telling everyone who was watching, we think the Republicans are going to win. And so I repositioned the portfolio gradually throughout the year, but especially in Q3, to introduce some small and mid-cap companies. And so once November 1st happened, our portfolio just took off and completely left the S&P 500 in the dust. And so we had a huge November, a strong December, and January, we've had a huge January as well. And so you got to be agile like this. And if you're not agile like this, if you're with one of the large institutions, you're just going to meander down the street and you'll never get to your destination.
So we can't have a conversation about markets, and this is pretty upbeat and pretty positive, but I have to bring up the C word, AKA the correction, or as some people might say, there's going to be a collapse. John, what do we do here?
I'm glad you brought that up because I've been hearing that a lot, both in my daily reading in the financial media, but also I hear it from clients and prospective clients.
Yeah.
And first and foremost, if you invest in stocks, whether the stocks represent 100% of your portfolio or 60% of your portfolio, if you invest in stocks, at any given time, you have to understand psychologically that the market can pull back by up to 10% at any time of the year, and you need to be able to deal with that psychologically. It's not the beginning of the end. It's just a temporary pullback because obviously the market tends to operate in the short term on enthusiasm and despair. And so when the market gets too enthusiastic, it goes too high and needs to be brought back down to earth. And likewise, periodically, it gets some despair because people panic over certain things and it gets too cheap, and then it corrects back upward. So 10% is on the table at all times. So the question then becomes, what about something greater than 10? What about 20%? What about 30%? Is there a calamity that's about to unfold? And my view is absolutely not, because if you look at the last 3 to 4 years, let's start with the end of 2021. The market peaked, the S&P 500 index peaked at the end of December of 2021. Then inflation reared its ugly head. The central bank started talking about raising interest rates. In fact, they did not raise interest rates in the first half, but the market heard the message, and the market started selling off. So the market fell roughly 23% by mid-year, a bit of a bounce, and then back down in October. So let's say 23% at the bottom, and then it started to recover late in the year. It ended the year at minus 18 or 19%. And then in 2023, the Mag 7 ran up and pulled the market with it. And so by the end of 2023, after 2 full years, the S&P was back to where it was at the end of 21. So 2 years of actually zero returns. Then comes 2024, you get a bit more participation by the broader areas of the market, including the small and mid caps to a degree. And you get a very good year that was, again, 2 years in a row in excess of 20%. Now, all of a sudden, the prognosticators are coming out and saying, well, 2 years in a row of 20+% returns, you can't have 3 years of 20+% returns. Well, that's nonsense. The mid 90s had 5 years of 20+ returns consecutively. And I'm not suggesting for a second that we're going to get 20+% return this year. What I'm suggesting is that it's a possibility to get that. And it's unlikely we're going to see any big collapse. I think, if anything, we're more likely going to see a pullback, a correction of up to 10%. But there is no reason for the economy, for the market to drop 20, 30% just because it's overvalued. Overvalued markets don't collapse because they're overvalued. Markets collapse because new information comes available that was not previously anticipated. The old black swan story, as Nassim Taleb, as he has said, it's the black swan. It's the thing you are not anticipating that will derail the market. It's not the things that you're already aware of. It's not the things that the media is talking about on CNBC or any other financial show. And so there is no reason today that the market's going to collapse and drop 20, 30, 40%. The market may drop 10% to correct a state of overvaluation, but it's unlikely for anything beyond that to take place because the fundamentals right now are sound. As I said, the stimulus from government spending is running out. We're transitioning to a new leadership in the United States, which is free market oriented, and the private sector will then take the baton and start running with free markets and provide additional support to the economy and corporate earnings to get us to the next stage.
Let me put it to you, under your definition of black swan, you could argue because that maybe DeepSeek was a little bit of a black swan because there was a massive correction, or do you not see it that way?
Yeah, no, I will agree. DeepSeek as an example of a black swan, something that most people, I shouldn't say no one because there's always somebody, but the majority of the population did not see the DeepSeek intervention coming. And so, yes, that was a black swan event. But as you saw, isolated in the tech sector, about a 15 to 20% drop in a lot of tech names. So if 100% of your money's
semiconductors.
Yeah, exactly. And so if you're 100% invested in that area, then yeah, you had your head handed to you for a short time. But as we've seen this week, there's been a big rebound occurring amongst some of the names, not all of them. NVIDIA is still trending sideways as people are trying to figure out what the next stage is for them. But yeah, that's a good example of a black swan. It's not a sufficiently large black swan, in my opinion, though. The big black swan is usually something more catastrophic, like a 9/11, for example.
I think something to keep in mind with DeepSeek, some of the information that's come to light in the days following the announcement have made it clear that the markets may have overreacted, and often do when something like this occurs or information like this comes out. The early results are that the technology is not nearly as robust as anything that we're seeing from U.S. counterparts like ChatGPT. When we were at our presentation on Tuesday, actually, one of our attendees said, they tried to, and not him personally, but he was watching a news segment where they were covering it, and they were trying to feed in certain information like what is Taiwan or who is, I can't remember who the individual was that they typed in, and DeepSeek couldn't find or couldn't return any results.
Yeah, no, I've heard that story as well. It didn't recognize nor want to acknowledge the existence of Taiwan.
Aside from that, and that's a very valid comment, but aside from that, this whole business about it only costing $6 million is absolute garbage. There's no way. There was a lot of work that went into it before that $6 million was spent. So we don't really know what the true cost is. So yes, it might be less expensive than what the US is doing in the AI industry, but there's no way that it only costs $6 million. And when you get information like that coming out of China with a communist government in charge, you can't believe everything you hear.
There are plenty of reasons why people might doubt data coming from the Chinese government. There's been a long, long history of reasons to be skeptical about it. But I was amused, and I want to hear your reactions to this before we turn our attention to Canada. The things that I heard were the cost of development was lower, the capital cost required to sustain it were lower, and those, generally speaking, guys, are pretty positive.
Well, it is positive if you can reduce the cost of creating this artificial intelligence and large language models and everything required to take AI to the next step. It is positive in many ways. Even Jason Wang of NVIDIA said, "Yeah, this is good because that means wider adoption of the technology, and that means an increase in demand for the GPUs that NVIDIA and others make." So, in fact, the lower cost means proliferation of technology increases at a more rapid rate, and that's good for everyone, including the American companies.
All right. So now we have to turn our attention to Canada, or as President Trump has referred to it, the 51st state. I don't expect we'll be annexing you anytime soon, but what's your lookout for? What do you see in the Canadian economy and markets?
Well, the frustrating part. We're obviously sitting here in Canada, and as a portfolio manager, as someone with an economics background, I see all the flaws in the Canadian economy, and the frustrating part is that Canada has incredible potential. The access to natural resources, the access to intellectual resources, to talent, is on an equal footing. I shouldn't say on an equal footing to the U.S. because a lot of our talent has left because of the current leadership in our country. But if we create an environment here in Canada that is based on free market principles and lower taxation and lower regulation, which is what the direction the U.S. is going in. If we take that approach, we have every bit as an opportunity to have the dynamism of the American economy, and so there's immense potential in Canada, and we have the rule of law, enforcement of law, et cetera, all the things that are required in a modern society. But we've had terrible leadership for 10 years. And it's really undermined our prosperity. It's undermined our incentivization to invest capital. A lot of capital has fled. A lot of talent has fled. And so inevitably what's happening in the next 3 months or so, we're going to have an election. There's going to be a leadership change. The new leader is going to be more free market oriented. So I think there's a lot of great opportunity in Canada for people who want to be patient. There's a lot of great companies here. I'll point one company out. This is not an investment recommendation, so that's my disclaimer, because I'm not here. I'm not going to be with you to tell you when to buy and sell it. There's a company called MDA Space. MDA Space is actively involved in satellite technology, and the Canadarm, that mechanical arm that works from the
space station.
Space station. Thank you, the International Space Station. Yeah. So you have companies like that. There's a lot of great opportunities potentially.
But I say but because I just want to interrupt you. I just want to be rude and interrupt you. Now the question is, though, what we do know for certain in regards to Canada, because of a number of political developments, is that your political leadership is going to be changing as well. I'm not I'm not making any predictions or do I have any idea who it's going to be or what it's going to be, but we do know change of some sort is coming to Canada. So what's the impact of that, and how do you assess that?
I think the impact is exactly what I said. I said we're going to be following the U.S. and their free market principles. We're going to see deregulation. We're going to see a reduction in taxes. We're going to see an incentivization to invest capital again. Let's back up a second and take a look at the U.S. So I follow what goes on in the U.S. very intimately because, for obvious reasons, I manage a U.S. stock portfolio. And the one thing that caught my attention early in 2024 is the fact that a poll was sent out and said, do you think the economy is going in the right or wrong direction? And I don't know if that the question was worded exactly like that, but the sentiment was very similar to that. And 70% of the people said no. We think the economy is going in the wrong direction. So that's the only poll you needed to hear to know that there was going to be a change of leadership in the U.S. And every other poll that asked about Harris and Trump meant absolutely nothing. When the population says they're fed up, they're frustrated, they're suffering economically, a change is coming. And we have the same sentiment here in Canada. People are frustrated. The Liberals are trying to change their leadership. They can put in whatever they like. They're going to lose because people have had enough. They want a change in direction. And so that means more than likely the Conservative Party in Canada. It means Pierre Poilievre is going to be the next prime minister. And he has the same free market oriented principles as not just Trump. That free market principles don't belong to Trump. Trump didn't invent free market principles. Free market principles.
No, they do not.
Yeah. Free market principles have been around for as long as Adam Smith, from the time of Adam Smith and Frederick Bastiat. So you have to understand that free markets create prosperity. The reason the U.S. became as powerful as it did was based on free market principles. And Canada, if it adopts the same free market principles, whether it's Pierre Poilievre or John Smith, that's not a real person, by the way.
Thank you.
It doesn't matter who the person is. If we follow free market principles, we're going to be far more prosperous. So I have a great optimism on how Canada is going to do in the future. It might take us a little while to ramp up, but I think we're moving in the right direction.
I do think that the Trump administration coming in helped accelerate the demise of the current government here in Canada. If you look at the popularity ratings, although Fidel Jr. had an abysmal popularity rating here in Canada for a long time, it actually took a real nosedive in November after Donald Trump came in and started making comments about the 51st state. And although he says that in jest, a lot of what it does is it shines a light on the incompetence of the leadership that we've had here over the last 9 years, and the response of that leadership to Donald Trump's commentary and suggestions that he was going to implement tariffs and that we needed to be harder on our border patrol. We needed to honor our commitments for the 2.5% GDP funding for national defense, I should say. Those are all factors that really highlighted how our government was not in an adequate position to be able to serve on a national scale, and that really accelerated the decline within his party, and that really ultimately forced him out and started this leadership race. Now, the only unfortunate part about it is, rather than doing what he should have done, which is to call an election, he prorogued Parliament, which is another fancy way of saying put Parliament on hold, asked the Governor General to delay the sitting of Parliament so they can choose a new leader, which basically delayed the time that was required in order to have an election. So rather than get a non-confidence motion that would have been tabled at the end of January, or voted on at the end of January, tabled at the beginning of January, that's not going to get tabled till March at the earliest, end of March at the earliest, if not later on. And that's the unfortunate part about everything that's going on right now.
Just to add to Alexander's properly insightful perspective on that, political hubris is what has put us in this position. The tradition in the Canadian parliamentary system is when an election is held and you only achieve a minority parliament and you find a dance partner to keep your leadership in place.
Yep.
The tradition is after 2 years, you call an election because you want a real mandate to get a majority.
Mm-hmm.
And this is the first time, as far as I know in history, that a Canadian government or a minority government locked up a dance partner to force us to endure them for a full 4 or 5 years, because we don't have a 4-year rotation. Ours can be anywhere from 3 years to 5 years. So this is the first time, and this is political hubris, both on the part of Justin Trudeau and on the part of Jagmeet Singh, who's the leader of the Socialist NDP party. Although these days you can't distinguish the NDP from the Liberals; they're both socialist. But these people are political opportunists, and had they accepted the will of the people, which is in the prior election to this most recent one, it was again a minority parliament. So when you get 2 consecutive minority parliaments, you have to understand that people are not with you and that you need every 2 years to get a new mandate until someone gets a majority. And had we done that, had we gone through that process 2 years ago, we could have very well have already been back on track to rejuvenate the Canadian economy. But instead, here we are scrambling with a prorogue parliament to bring in someone new for the socialist liberals to try and save their party, which is not going to happen. It doesn't matter who they choose; they're going down in flames.
The frustrating part, one of the frustrating parts about it is, Justin Trudeau resigned because he said he'd lost the confidence of the party, which basically means you've lost the confidence of your constituents. If that's the case, you should be calling an election. That is the whole notion of a minority party. Is you never had, like my dad said, the full confidence of the people. If you have now lost the confidence of the people who did put you in power, then it is incumbent upon you to call an election and give people the opportunity to choose a new mandate. Now, the one good thing that has come out of this is it has basically killed the new capital gains changes that were proposed to Canada. So for those who are unaware, there was and I can't imagine anybody is unaware, but the capital gains inclusion rate was going to be increased beyond 50% for capital gains over $250,000, which would have impacted a large number of individuals. Now, the good thing about this being, because it was never read in Parliament and nobody's actually voted on it, proroguing Parliament basically kills any active bills that are on the floor, including this one. And so it would require whoever takes over to reintroduce the bill and then try to get it pushed through, which at this point is, so unlikely that it's not even worth mentioning.
Frankly, Alexander, I don't even know that they created a bill. They were still working on the details.
It was still in draft legislation.
That's right. So a bill was not even on the floor at the time. So yeah, it's absolutely crazy. And meanwhile, our taxes our equivalent to the IRS, the CRA, Canadian Revenue Agency, is expecting Canadians to document capital gains above $250,000 in 2024 at the new 2/3 rate and pay tax on it, and then apply for a refund afterward if it doesn't actually come to pass.
Now, you don't necessarily have to. That's the recommendation. And one thing that people can keep in mind is they don't necessarily have to comply with the recommendation. They can choose to file at the 50% rate or 50% inclusion rate, which is what a lot of professionals like Kim Moody, who we've had on the podcast several times, have advocated for. The other thing to keep in mind is that the Liberals actually even mentioned yesterday they may even be willing to just drop it entirely before the election, so that way people can file under the old system. It's another Hail Mary attempt on their part to try and curry some favor with the voting populace. But the bottom line is that proposed legislation is basically dead in the water, and Canadians need not worry about it whenever they're filing their taxes come the spring.
So I got a practical question for you guys as we get ready to wrap up this episode. When is there going to be an election?
The Parliament is going to return at the end of in the final week of March. If an election is called immediately, then we're looking at a 50 to 60 day window. So probably at the beginning of May is when we're going to have the election.
Do you think that's going to happen?
Yeah, I think it's going to happen. The pressure is immense right now. Absolutely immense, especially given that Trump is pushing hard on his end for all the things that are important to the United States. But as I said at the beginning, I think it's important to Canada, never mind the U.S. I think Canada, on its own, needs to be having a strong and secure border to avoid illegals and drugs and all those things. So yeah, with that pressure on, I think they're going to have no choice but to call an election.
Yeah, had we had an administration that was more similar to the previous one in the United States, and you had somebody who was more of a wallflower, maybe we would not see an election until the fall. But the fact that Donald Trump continues to put the pressure on an ongoing basis more or less guarantees that we're going to have an election, because what this proroguing would have done is it probably would have taken you take the lid off and it lets the pressure out, and things would have simmered down. There probably still would have been a lot of people in favor of an election, but some of the hot button issues would have kind of slid under the under the rug for the time being. But the fact that Donald Trump continues to bring them to the forefront has forced a lot of the politicians here to confront the reality that there's no way they can wait till October to call an election. They need to be calling one in the spring.
Interesting. Interesting. Well, we look forward to see what happens in Canada and see if, see when the change, whatever it may be, it will be coming about. Before we wrap this up, guys, I've got a quick question. Do we have an idea of what we're talking about in the next episode of this podcast?
Absolutely. We're going to be talking about financial planning for young adults. It's a topic that was suggested to me by one of our attendees at our presentation on Tuesday. I thought it was a fantastic idea, and so we're going to be touching upon that in the next episode.
Wow, that's great. So as we leave this episode behind, we can't go away without making sure that people who are listening to this podcast understand how they can get in touch with you all. Alex, what is the best way to reach out and maybe start a conversation?
Best ways to visit our website at medwealth.ca. That's med-wealth.ca.
Excellent. And do so if you're listening to this podcast and you find it interesting and you don't already have a relationship with them. You probably should. The other thing you can do that's really easy is, if you're not a subscriber, become a subscriber. And that part just involves you hitting the follow button. That's not hard at all. And when you do that, you will be automatically notified when new episodes of the podcast are dropped. The other thing I would ask is, if you like this podcast, if you find it interesting, you find it useful, you find it informative, tell people about it. Word of mouth promotion is a marvelous tool, and we would very much appreciate it. So until next time, I'm Bill Tucker. On behalf of John and Alex and everybody at MedWealth Financial, thank you for taking the time to listen today. And as we go out, I'll remind you, you can go out today and make today a great day, or not. It's your choice. Have a good one. Until next time.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.